Welcome to Investors Guide. Thank you so much for tuning in. There's a lot of news happening from across the world, whether it's about Greece or the Eurozone. And normally as investors watching the stock market, we tend to get a little worried about whether or not that will have any impact on us. Well, what we're going to do over the next half hour is tell you how you should be minding your portfolio when all of this is going on. And if you have any questions, you know you can write to us. Our email ID is at the bottom of your screen. We'll start off by talking about a young investor and help him build his own home in the next 5 years. In our product review, we look at the SBI Magnum Taxgain Scheme, and we'll give a first-time investor a strategy for mutual funds later on the show. It's time for me to bring in Kumar. Thank you so much for joining us.
Thank you.
We are getting a few questions from investors who might be worried about what's going on in the rest of the world in terms of Greece or in terms of China. As Indian investors, retail investors, do we have anything to worry about?
Yes, it's a big noise, and you have reason to worry about in terms that, it will cause great volatility in the market, and that will cause anxiety. But I don't think, investors of the kind whom we address, or the kind of investors who save and accumulate their savings in a prudent way, should do anything about it. It is very important for investors to stay focused on their plan, and there are a few things for most investors to do. Not to not to lose their objectivity, remain diversified, be with good funds, and not get distracted by such a thing.
All right, so always the advice remains the same. Keep a diversified portfolio, pick good mutual funds, use an SIP, irrespective of what's happening in the larger market or the global market. As long as you stay on track, you should be okay. In fact, we have one such investor who's written to us in our portfolio question. Well, 31-year-old Kiran has written it to us, Dhirendra from Pune. He tells us he's married, but his parents are not dependent on him right now. And although he doesn't have any children, he does want to plan for his child's future. He'd like to have 50 lakh rupees over the next 20 years as a retirement corpus and 15 lakh rupees for his child's education. And he has some short-term goals. He wants to buy a car next year and build a corpus of 7 lakh rupees to start construction on his home after 5 years. He sent us a list of all of his investments. Dhirendra, he has surplus of about 10,000 rupees a month, PF, PPF, NSC, RD, and of course a couple of ULIP investments. He has a term plan. I'd like him to increase that coverage and a health insurance as well. Before we go any further, I want you to just take a look at his portfolio. If we were to put all of these things on the table in front of you, he does seem to have PF, PPF, there's an RD as well. There's a money back plan, there's an income fund. It just seems like there hasn't been enough thought put into the fact that he has long-term goals. How would you like him to allot the money between the home he wants to build in the next 5 years and the child he wants to provide for over the next 15 years?
No, I think he needs to really unclutter his portfolio. He has too many things on his plate. He has done very well to accumulate his savings, but he has not done a good job in, putting it in a manner which will optimize his return. So he should work sequentially, just the way you started, that he should get adequate term cover, he should have an emergency fund, he should get a medical cover, a health insurance coverage, and after that he's accumulating his savings for his house, and he also has a lot of real estate spread all over. So consolidating that, it apparently looks that investors get carried by an investment in real estate. That's a wrong way to approach it, for the sake of liquidity, convenience, manageability, and all these factors, and also long-term orientation. If you have long-term orientation with your equity portfolio, it just works. It works just as well, except that the perception of real estate is that it provides great return, and it does. But the big difference that we don't absorb is that most real estate holdings are really long-term. Buy a flat, build a home. Beyond that, don't look at real estate as an investment, and keep it liquid and be methodical about your equity investments. So much money going into your PPF and 50,000 mandatory savings, getting into your provident fund and the ULIPs, they just don't make sense. Exit them methodically. Of course, PF is not a negotiable thing. That is the employer deduction which goes into it. At some point, it will be possible for investors to choose between NPS and EPA, your provident fund, and at that point, and it is likely to happen sometime because it was announced in this budget itself. I would like you to consider moving your money to NPAs as and when it becomes possible.
Well, Kiran, the advice you're getting right now is that every time you buy more than one piece of property, you have to consider all of the expenses that come with it: stamp duty, registration, property tax, maintenance, that sort of thing. And like Dhirendra was saying, property tends to be very illiquid. If you want the money back, it takes close to 6 months to a year to liquidate a property asset or to sell it. These are all things you should consider before you add more property to your portfolio. But Dhirendra, let's take a look at his mutual funds. It's a very interesting list of funds. Franklin Liquid Asset Management Super Institutional Plan. I'm not really sure why he's holding it. He also has HDFC Prudence, Franklin India Smaller Companies, IDFC Premier Equity, Franklin India High Growth Companies, and the Mirae Asset Opportunities. Now, these are all high performers, Dhirendra, but do you think that he needs to relook at his portfolio altogether, or are you happy with the way he's designed it so far?
Franklin Liquid Asset Management Super Institutional Plan, I don't see a reason for it. So maybe I'm unaware of the reason. If that happens to be his emergency fund, or if that happens to be the money from where he's doing his STP into 2 other Franklin equity funds, that may be fine. Also, I don't see a rationale for having that HDFC Prudence a balanced fund, because he has his fixed income elsewhere. He can do without it. So by dropping these 2 funds, I think his portfolio is poised for aggressive growth.
All right, so you seem to be on track with your mutual funds. And remember, if you have any other questions, you can get back in touch with us. But stay on track and stay with a larger plan. We have a question from Atul Nagpal, Dhirendra. He recently began investing in mutual funds with SIPs of 2,500 rupees in Mirae India Asset Opportunities. He now wants to invest in one of the large cap funds for the next 5 to 7 years. And he wants to know, does it make sense to choose the BNP Paribas Equity Fund, the SBI Blue Chip Fund, or is there any other fund that you have in mind that you think he should be using for 5 to 7 years? What's your recommendation?
BNP Paribas Equity is has a very compelling history if I have to choose one of the 2. And SBI Blue Chip is a fairly well performing large cap fund. So in that sense, if he is looking at an opportunistic position, I would say both funds are good. If he is looking at an opportunistic position, the BNP fund will be a better choice. If he is looking at a steady large cap fund, SBI Blue Chip.
All right, SBI Blue Chip. Now, it's time for us to take a quick break. But before we go into break, remember, it is the month of July, which means Form 16s are being distributed in your office, and you have till the end of the month to file your taxes. The good news is you can do it online, and it's relatively easy. My colleague Krishna is here to guide you through the process. Krishna.
Thank you, Faye. It's that time of the year when everybody is scrambling around trying to get their hands on the Form 16 and file the all-important income tax return. But this time around, I suggest you do it all online. Here's how it works. First, log on to incometaxindiaefiling.gov.in and register yourself using your PAN number, which will be your user ID. Download the income tax return form applicable to you. A return preparation software, that is ITR Java or Excel utility, will be provided along with it. Complete the form using all the details from your Form 16. After that, validate the ITR utility form and directly upload it on the website by logging into your account. You'll immediately get the acknowledgement details, and an ITR-V for verification will be automatically generated and sent to your registered email ID. Now, if you've used digital signatures in the IT form, then the process gets completed once you get the acknowledgement details. But in case you haven't, take a printout, sign it, and send it across by speed post or normal mail to the income tax office. Now keep in mind, from this financial year onwards, you have the option of linking your Aadhaar card with your income tax return form. Once you do that, you don't need to physically send the form to the IT office, even if you didn't use digital signatures. With that, it's back to you, Faye, in the studio.
All right, Krishna, thank you for that quick guide. Coming up after the break, Dhirendra is going to stay with us and we'll talk about the SBI Magnum Taxgain Scheme. That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide in ET now. Thank you for staying with us. Remember, if you need to get in touch with either Dhirendra, Kumar or me, you can reach us both on Twitter or you can write us an email. Our email ID is at the bottom of your screen. It's time for us to move on to our product review. This week we're looking at the SBI Magnum Taxgain Scheme, the largest tax-saving fund in the country. Avan is here to give us a quick introduction. Avan.
Thanks, Faye. This week we look at one of the largest tax-gaining funds, the SBI Magnum Taxgain Scheme. The fund was a stellar performer during its early years after its launch in 1993, but it hit a rough patch in 2007, underperforming its benchmark and the category. The fund has seen several changes in its portfolio ever since, with the fund manager taking a growth-oriented approach. Let's take a look at its performance graph over the last 5 years. The blue line is the fund and the red line is its benchmark, the BSE 100. Now you'll see that the fund has been an average performer in a rising market over the last couple of years. However, it stands out in a market downturn with its ability to restrict its fall when compared to its peers. You'll also notice that the fund has performed better than its benchmark and the category in the years that follow. The trailing returns show that the fund has consistently outperformed its category in the 1, 3, 5 and 10-year time horizons. The fund may have sought a new and disciplined approach, but it still lags behind its peers on the performance chart. The growing concern towards the investment team and its approach may have declined, but will the fund regain its stance as a top-performing fund in its category? Should you stay invested in this fund? Let's find out. With that, it's back to you, Faye.
All right, Avan, thank you for those numbers. Dhirendra, like Avan was just telling us, the fund has had a couple of rough years. It's starting to look like a sort of checkered track record. But the question a lot of investors who are still holding on to this fund are going to be asking is, will it at any point regain the glory of the past when it was a top performer for 3 straight years? Are you expecting that to happen, given the fact that we are seeing numbers improve for the fund slightly over the last, over the recent past?
That looks unlikely, regaining its old glory. And, in 2005, 6, 7, when it was, among the, it was the best performing fund among tax savers and it actually accumulated assets. But I think that looks unlikely because it has turned big and it is competing with a larger universe. There are far too many compelling options in this category. Though this fund has improved its performance substantially, I don't think investors looking at this fund in isolation should have anything to be disappointed with.
Dhirendra, what's your recommendation for investors who are holding the Magnum Taxgain outside of the lock-in, of course, after finishing 3 years? And for those who are looking to buy a tax-saving fund for this year, would you recommend the first set of investors stay invested? And for the second, where would you recommend we put our money this year?
If you're looking for an equity fund which will do well, will provide return with great stability, at the same time, we should be able to beat its benchmark or beat the index, I think this is a decent fund. Don't expect what it did in 2005 and 6 and 7.
All right, so depends really on your expectations from your fund. If you are expecting decent returns, beating the benchmark, then this might be the fund for you. Dhirendra, finally, your rating of the SBI Magnum Taxgain Fund on Investor's Guide.
I'm inclined to give it a 4-star for its stability, the kind of stability that it shows of late. And on a risk-adjusted scale, it is a 3-star fund.
All right, that was the SBI Magnum Taxgain Fund on Investor's Guide. If you have questions about that fund or any other fund you have invested in, feel free to write to us. Email ID is, as always, on the bottom of your screen. Let's move on to our hold or sell segment. Well, 32-year-old Lokesh Kumar has written in, Dhirendra. He sent us a list of his mutual funds. He's been investing 5,000 rupees in these funds since 2012, and he wants you to take a look at his funds and tell him whether he should stay invested. Now, here's the thing. He has written in saying that he has a father, a wife and a child who are dependent on him. He has an income of 60,000 rupees a month, medical insurance from the company. He seems to have some policy from LIC, I'm not sure what it is, and PPF of 1.5 lakh rupees per annum. So actually, if we compare it, Dhirendra, first of all, before we go any further, I would like Lokesh to remember that we want him to get life insurance as soon as possible, a term policy, given that you have 3 dependents. But he's got 1.5 lakh rupees going into his PPF, and he has 5,000 rupees a month going into his mutual funds. Now, given that allocation, do you think maybe he needs to step back and reassess why he's investing his money in that manner?
Review your position in PPF, maybe marginalize it, make the essential investment just to keep your PPF account live, the minimum investment that you can make every year, and substitute your contribution to PPF with ELSS. I think your accumulation in with a tax saving fund for the same cash outflow will be nearly 1.5 times to twice as much. which I think is, you know, phenomenal, and it'll come in as a very substantial accumulation in 15 to 20 years' time.
All right, so what I'm going to do is I'm going to put a list of the ELSS, or the tax-saving mutual funds that we have recommended for this year. It's on your screen, and this is the conservative list, because when you're moving from a PPF to ELSS, you wanted to take a slightly conservative view. But Dhirendra, let's take a look at the funds that he's invested in one by one. Right on top is a Franklin India Blue Chip Fund. Should he continue this investment?
Yes, it's an excellent large cap fund, but maybe for somebody, you know, who is conservative, it might be a suitable investment. But for somebody young investing for many years, it might turn out to be too conservative.
Well, the next on his list is the IDFC Premier Equity Plan. He has a little more going into this fund than he did in the previous one. This is obviously more suited to his age and his horizon, isn't it?
Yes, this fund actually made a name for itself in the last 5-6 years for very different kind of management. And there has been a change of fund manager. I hope that it continues. So one should be watchful. But yes, it's a kind of fund he should continue.
Well, he only has 4 funds in his portfolio, 2 of which are HDFC Top 200 and HDFC Equity Fund. Would you like him to combine that investment and just use one of the 2?
Yes, he should combine the investment, and given his time frame, I would like him to, you know, carry on with his HDFC equity, and maybe that fund is good enough because, you know, there's a large complementary position in both the funds portfolio. So he might have the impression that he's carrying 2 funds or he's investing in 2 funds, but a good part of his money is managed by the same person with same set of stocks.
And finally, he has an additional 3,000 rupees he'd like to allocate every month, Dhirendra. Should he just spread it over the 3 funds he now has after your advice, or would you like to add a 4th fund to his portfolio?
I think, you know, even adding one more fund may not be too many. So I would like him to, you know, add a different strategy, some value-oriented fund in this portfolio. I would suggest him to, you know, add one more fund from a different fund company, you know, ICICI Pru Discovery Fund, or some similar fund. Might be a complementary, desirable position.
Dhirendra, thank you so much for joining us on the show and answering all of our questions. It's always a pleasure to sit down with you.
Thank you.
Coming up after the break, we'll give a first-time investor his first strategy. That's on the other side. Don't go anywhere. Welcome back. You're watching Investors Guide. Thank you so much for tuning in. We've asked Feroz Aziz to join us today and answer some of the questions you asked on asset allocation. Feroz, thank you for joining us.
Thank you.
Our first question comes in from 27-year-old Rohit. He's written in, he wants to put aside 5,000 rupees every month in mutual funds. And here's the interesting thing. He says he's investing for the long term of 5 years. Now, Rohit, if you're only 27 years old, long term, in my book, for you would be 30 years. You should be investing for the next 30 years at least. Now, if you're investing in equity mutual funds, you want some sort of a strategy. My advice to you would be to start small and then slowly add more and more funds to your list. But Feroz, what would you recommend he does?
Rohit, I think it's a very good thing that you're starting off your investments, especially in the equity orientation, which you have exhibited as an interest. I think your age definitely favors being in equity. And I think if you have 5,000 rupees to invest, in my opinion, you should look at equity and use your PPF and other debt instruments, like if you have a PPF that could form a debt portion. On the equity side, I'll recommend you 2 good equity mutual funds which you can consistently invest and upscale it as your disposable incomes go up. One would be an Religare mid and small cap scheme, which is a mid cap scheme which actually invests in stocks which are potential large cap. Which might be smaller today, but they would turn to be large cap companies over long periods of time. So Religare mid and small cap scheme is one of the schemes, and the other one would be Mirai Asset India Opportunities Fund, which is managed in the large cap space, which invests in stocks which are larger in size. Gopal, the CIO, has done a brilliant job in actually doing a bottom-up stock picking on the large cap side, which is a tough task, but he's done it very efficiently. So these 2 schemes consistently, if you keep investing, discipline is what I would suggest as the core prime requisite to make sure that your maturity amounts are large enough.
Our next question comes in from 31-year-old Ganesh. He tells us he hasn't begun investing yet. Don't worry, Ganesh, it's never too late to start investing. Now, he plans to move overseas and work from the US over the next 3 or 5 years. He wants to know if this is the right time to start investing, or should he wait until later? And if he began investing in Indian equity mutual funds, What are the tax implications of being an NRI? That's an excellent question, Ganesh, and there's very little for you to worry about. I still recommend you start as soon as possible. But Feroz, what tax implications will there be?
The tax efficiency when it comes to mutual funds is significantly higher. On the equity side, taxation on mutual funds is absolutely, it's tax exempted if you hold an equity mutual fund for a year, which is an amazing benefit because there's nothing else in the country which is taxed at zero except agriculture for that matter. So to my mind, equity taxation on the mutual fund side, post a year is 0%, and less than a year, which is called short-term capital gain, is taxed at 15%. But the other thing, which is the debt component or the debt mutual funds as they call it, will have a little differential taxation. In fact, on the higher side, short-term capital gains is taxed at the highest tax slab, depending on your tax slab. And on the long-term capital gain side, which is 3 years, you'll have to hold a scheme in the debt category for 3 years to be categorizing the gains from it as long-term. Once you categorize them as long-term, the tax is 20% with indexation. So that indexation benefit of 2-3 year indexations can actually bring down your tax liability significantly. So debt taxation because of indexation comes down significantly. But yeah, it's basically a mutual fund is a tax haven to invest. So should you start when? To my mind, mutual funds you don't have to time so much because they are a basket of shares. If you buy the equity side, if you buy the debt mutual fund, you have a basket of bonds. Since there's a basket, timing becomes irrelevant. So you starting right away, I think will have no harm, irrespective, as long as you have a longer kind of a time frame to get into equity.
All right, 66-year-old B.S. Rao wants to begin investing in mutual funds. He says he wants some funds that he can start investing in, and he also wants to know if debt funds give higher returns than fixed deposit. Well, if he's someone who's never invested in mutual funds before, we would recommend that he takes a slightly more conservative route, perhaps look at a balanced fund or so. And as far as debt funds are concerned, Feroz, obviously they're recommended to investors who should be using them over bank fixed deposit. But what sort of a higher return can he expect?
So it's very individualistic. If you are in the highest tax slab, definitely not a fixed deposit. A debt mutual fund will definitely give you 200 basis points more, that is 2% more, and that's a lot when it comes to debt. So that's completely dependent on which tax slab you are in. Lower tax slabs you should be indifferent. If you're on the higher tax slabs, debt mutual funds would be significantly better if you have the capacity to hold it for 3 years. Then coming to what should you do with your money? In my opinion, since you have a large corpus and this could be your retirement corpus, I would say a large portion of the money also needs to be in debt. But if you look at the contemporary situation of how the equity markets are expected to behave in the next couple of years, I think equity should form a part of your portfolio, but not a very large part of portfolio, at least 30-35% should be in equity. So let me recommend you a good mutual fund which will be able to manage risk for you and still give you a fillip on your overall portfolio return. On the equity category, you can look at an SBI Magnum Blue Chip Fund, a Birla Sun Life Frontline Equity. On the debt category, you have two kinds of debt funds. One are called the short-term fund. There's another which is called the corporate bond fund. In the corporate bond fund category, you can look at HDFC Corporate Bond Opportunities Fund and ICICI Regular Savings. These funds, how are they different? They give you a marginal higher return, but they take papers of smaller corporates as well, just like a mid-cap fund which would do in an equity category. And on the debt side, which is short-term category, you can look at UTI short-term fund and the Kotak bond short-term fund. So these 6 funds, all divided 1/6 each, I think will be a reasonable mix for your 80 lakhs, Mr. Rao.
All right, Feroz, thank you so much for answering our questions. Remember, if you have any questions at all, especially to do with your taxes, write to us. Email IDs at the bottom of your screen. And remember to file your taxes in the next 1 month. Otherwise, you're going to have to pay a fine. Take the help of a good CA if your taxes are a little complicated, but make sure you get it done on time. All right, that's a wrap on Investor's Guide. Stay in touch. Reach me on Twitter. It'll be my pleasure to hear from you. Thanks for watching.